Happy to take questions as we go. If it's probably easiest if somebody just shouts or sticks a hand up, and then somebody can let me know if I can't see that, that they've stuck their hand up. Then that would be great. But also happy to take questions at the end if you like. We will pause at the end of kind of my session about the valuation so that you can ask questions, and then at the end of the session about ill health as well. So yes, what I'll cover initially is background to the 2022 valuation, what we've done so far, the kind of funding themes and the Academy contribution rates for the pool and the work we've done on that, and then what there is for you guys to do from this point onwards towards the end of March when we finalise everything. There's a picture of me that doesn't really look anything like me these days. But yes, and you'll get a lovely picture of Martin soon when you get to his slides as well. So you'll get to see his glorious mugshot. So start off with a little bit of background about the 2022 valuation. The valuation that we do every 3 years. And one of the main outputs really, and one of the main reasons to do it, is to work out how much money each employer should pay in to make sure that there's enough money to pay out and the benefits to all the members as they fall due. How the fund works in general is what this slide's about. So it's a very simplistic kind of slide and kind of taking it down to the base level of money comes in from contributions. So that's from both you guys as employers, as academies in the fund, but also from the members themselves. They pay a contribution rate based on a particular kind of scale, and that money is invested by the fund. So the fund essentially has a pot of money there. It's not the same as, for example, the NHS scheme or the police scheme or the firefighter scheme, because there is actually a pot of money there that is being invested instead of just kind of the money in being used to pay all the benefits back out again. So it's slightly different from those schemes in that sense. So that money is invested, it earns investment returns, and also there is money that has to be paid out to actually pay people's benefits that are already in payment. So pensioners that are already in payment, for example. So basically, it's the contributions coming in and the investment returns that are achieved on that those assets or that money that fund all the benefits. Now, the fund is really kind of a collective term for what is around about 530 employers in the Hertfordshire Fund. That includes what we call ceased employers. So you can have employers who have been in the fund and then the last active member has stopped earning benefits. So ultimately they've probably left employment, and that employer would then become what we call a ceased employer. But those benefits earned up until that point by all the members that were associated with that employer still remain within the fund and have to be paid when they fall due. So there is still a liability there and also a corresponding kind of pool of assets for that employer associated with that employer. So each employer has to kind of tend its own field, if you like, which is what that picture is supposed to kind of show, is that the fund is made up of all these different patches of field, that each individual employer kind of tending their own patch, if you like. And all employers are different, and the funding strategy that the fund has is tailored accordingly to each kind of group of employers that has similar characteristics. So we do look at the academies particularly, and see what's an appropriate funding strategy for academies, because you guys are relatively similar in terms of characteristics of your membership. Now, a key funding decision that we have to make at each valuation is where do we draw the line? Where do we strike the balance between contributions payable by employers and the investment returns that can be expected to be achieved in the future on the money that's already there, the assets that are there, and indeed on the contributions that are coming in. So we do have to strike a balance there between the contributions that are coming in and the investment return that we expect to achieve. And that's essentially what kind of pays for the benefits. So why do we do a valuation? The top one there is probably the most important, if you like, is to calculate appropriate employer contribution rates. It's obviously very important to make sure we've got enough money in the fund that we think is going to be enough to pay the benefits. And as more benefits are accrued, so more benefits are earned every day by members, you have to make sure that there's money coming in to cover the cost of that. Second reason there is compliance with legislation. So it's kind of in legislation and in the regulations that we have to do a valuation every 3 years. So that's another good reason to do so. And also it's a good opportunity to analyse the experience that the fund's had against what we assumed at the last valuation, so we can kind of tinker with our assumptions to make them as close to what's actually experienced as possible. It's also an opportunity to review what we call the funding strategy statement. And that funding strategy statement is basically kind of the Bible of the fund, if you like, in terms of how all the employers are treated, how the contribution rates are calculated, how an employer is treated when they come into the fund, and how they're treated when they go out of the fund, if they do so in the future. So that's kind of a very important document from the fund's perspective, from a governance perspective, and that is reviewed at least at every valuation. And you might recall it's actually been reviewed since the last valuation due to changes in regulations, and was consulted upon last year or the year before about some changes that were made due to these regulation changes. So that's reviewed at each valuation and has been at this valuation, and I'll cover a little bit on that later on. It's also a good opportunity to do a kind of health check on what we call fund solvency. So that's how much money do you have now, and how much money do we think you ideally need now, given the benefits that have been earned up until the valuation date. And so we say, kind of, do we think we have enough money in the pot now to cover what we've already earned in benefits to now? So it's all in all, it's a kind of, the valuation is a good risk management tool for the fund to do every 3 years. So how do we actually do the valuation? Well, on the left-hand side there is kind of the information that we use in our calculations. So a very important part of that is the data for each member, and that's what we get from LPPA, who you guys submit information to about all your active members. And that information is essentially what we use. Excuse me while I clear my throat. So that information is what we use to try and project what benefits are going to be payable from the fund in the coming decades. So this is pensions we're talking about. There'll be people who are kind of in their 20s, and so their benefits aren't going to be payable for another 40 odd years, and we have to project what we think they might be based on kind of how much they've earned up until now in benefits. And in order to do that, in order to project those payments of what we think might be paid, we have to make a lot of assumptions. So that's the kind of financial and demographic assumptions part there, which we discuss with officers before we crack on with the calculations and make sure that they're appropriate. We also consider the funding and investment strategy, and that's something that's done kind of in tandem. So we make sure that the assumptions we're using are in line with what the investment strategy is for the fund. And we obviously bear in mind the benefit structure itself of the LGPS to make sure we're using the right benefits. We then kind of do all the calculations in the middle there, and then what comes out the other end is you will each receive an individual employer results schedule, which will show your own employer funding position. So it's not, as I said, it's not just the whole fund and that's the funding level. Each individual employer underneath has its own funding level, and that will vary from one to the other. And so you'll each get your own individual employer results schedule showing your funding level, and it will also show your contribution rate that's payable. There's the updated funding strategy statement, which I'll mention a little bit later on. So that'll come out for consultation for you guys to have a read and come back with any comments you have. And then the final valuation report on the whole fund is produced before the end of March next year. And that will contain kind of a lot of the background information and the processes that have been gone through. So what have we actually done up until now? So what we've done for the Academies pool is we've looked at how to set the contribution rates. We've done it in the same way as at the last valuation. So if you're in the Academies pool, the contribution rate is kind of worked out at pool level, and so you all pay the same percentage of payroll in to the fund. So we use this risk-based approach to calculate the contribution rates, which basically projects the position from now and 5,000 different scenarios into the future as to what might actually happen, because obviously we're talking about the real world here. There's no kind of one line that we can say that's exactly what's going to happen. So we use 5,000 different potential future financial situations, and we project to see what they might look like. And what we do is we say we want a certain likelihood of success, so a certain number of those 5,000 we want to be above 100% funding at the end of the time horizon we're looking at, in order for us and the fund to be happy that that's a kind of prudent enough contribution rate that we're allowing for. So that's kind of how it's done. In terms of the approach for you as Academies, as I say, that's not changed since the last valuation. We're still got a funding target of kind of an ongoing basis. You are ongoing employers. We don't expect you as Academies to leave the fund anytime soon. So we have a funding target on what we call the ongoing basis. The time horizon we use is long, because we're expecting, as I say, you guys to be in the fund for quite a long time. And what we call the likelihood of success, so that's kind of how prudent we want to be in terms of how likely it is that you're fully funded at the end of that time horizon. We use 71%, and that's the same as was used at the last valuation. So there's been no change in terms of the funding parameters since 2019, and those parameters will be kind of stated in your results schedule as well when you receive that. So what's the kind of general themes and the Academy contribution rates that are coming out? So the general theme since 2019 is that assets have gone up quite a bit, and that's because of good investment returns that the fund's had over the last 3 years. So generally speaking, there's been quite a jump up in assets. Liabilities have also gone up a bit, but potentially kind of in general, not necessarily by as much. So you may see an improvement in your funding position when you get it. Now, the reason I say may is because that impact does vary by employer, and it very much depends on your kind of your own funding profile and kind of how your characteristics are of your membership, and also the membership experience of you as an employer over the last 3 years. And particularly for Academies, that can vary quite a lot in a 3-year period, because we do see quite a lot of membership movements for Academies. There tends to be quite a lot of kind of new active members, which can move the kind of cost of benefits quite a bit, depending on how that affects the profile of the membership. So it will vary from one Academy to the next, how your funding position has moved. It may have got better, may have got worse, but in general, we're seeing quite kind of positive results from a kind of rising assets perspective. So what does that actually mean from a contribution rate perspective? So for the Academy pool, your rate that you pay to the fund at the moment is 22.65% of pay. The modelling that we've done based on those kind of 5,000 scenarios into the future suggested that the fund may be able to reduce that for the next 3 years by kind of 1% of payroll. So that would drop down to 21.65% of payroll for the next 3 years. That's kind of preliminary, because we're still to produce the kind of final results for each academy, but we're not anticipating that changing. So at this stage, it's certainly looking like a kind of positive result from a contribution rate perspective, is that you should be able to see a kind of 1% of payroll drop in your contribution rate from April next year. That's if you're within the pool, and that's the contribution rate payable to the fund. If you are out with the academy pool, you do have the choice to not be in the academy pool, and some academies might not sit within the academy pool at the moment. Your contribution rate would be calculated kind of individually based purely on your funding position, and could vary significantly from the figures shown there, which are basically a kind of average of the rates for all the academies in the pool. You do have a kind of decision to make at every valuation as to whether you want to be in the academy pool or not, and that's something that I think officers will be in touch with you about shortly, just to confirm one way or the other whether you'd like to either remain in the pool or kind of leave the pool, and get your own rate applied. Ill health liability insurance we'll cover a little bit in a few slides shortly, but if you do choose to insure against ill health retirement strain costs, then those premiums are payable to the insurer, in addition to this contribution rate. So again, it's the same approach as the last valuation, whereby the contribution rate you pay to the fund is one figure, and then if you choose to insure against this ill health retirement strain cost, then that premium gets paid separately to the insurer. Now, whatever the contribution rate is will be outlined again in your own results schedule that you'll receive. We're hoping to issue the results schedules during December, so in the next few weeks. So hopefully you should get those relatively soon. There are a few other factors that cause the funding level results to change. Funding profile in terms of kind of the balance between the benefits that have been earned to date and kind of what we expect to be earned in the future. That can differ between employers based on, for example, the age of your membership. If you've got a kind of comparatively old membership, then there might be more past service than future service, and that does have an impact. As I mentioned earlier, membership experience. So you may have had an ill health retirement that's had a bit of an impact on your funding position. You may have given higher salary increases or lower salary increases than another academy, and that could affect your funding position as well. And those are just a couple of examples, but there's various different things that impact membership experience that can result in a different movement in your funding level from another academy's. And the membership profile, as I mentioned, kind of the age and kind of gender can impact the contribution rate, because that impacts kind of when the benefits will be paid and for how long generally, and so that can change between one employer and the next. So we've kind of said at the bottom there, no two employers are the same, and so the movement in funding levels can differ from one employer to the next. So a little bit about funding strategy statement. As I mentioned earlier, that's the kind of the Bible or kind of blueprint of the fund from an employer's perspective. There's been no material changes in that funding strategy statement, or the funding strategy at the 2022 valuation. What we've done with the document itself is that we've used the opportunity to restructure it and try and make it a bit more concise. For those of you who were around at the last valuation, you might remember it was about 50 something pages long, so that's been cut back quite a lot, and the idea behind that is to try and help with kind of being able to see the wood for the trees, if you like, and actually make it a bit more concise and a bit more user friendly. So hopefully that'll be a bit of an easier read for you guys this time around, and ultimately that will go out for consultation to all employers around about the same time as your results come out, so that you have them both kind of side by side to see how your calculations have been done and kind of what the results are. So please do read the FSS when it comes out and kind of understand kind of how you're impacted by it, and do let the fund know if you have any thoughts or comments on it. So what to do now? As I said, we expect to issue your results schedules in December, so do check that everything looks right on it from a data perspective. Do have a look at your funding position and note the contribution rates that will be payable from the 1st of April 2023. As I just mentioned, review the funding strategy statement and do feedback any comments you have, and just in general kind of talk to the fund. They're there to help if you've got any queries, and also, as I mentioned, they'll be in touch about your confirmation one way or the other whether you wish to be in the Academies pool. I think that was all I was going to say at this stage, but happy to take any questions from anybody about that before we move on.
Any questions? Nothing at the moment. Barry, if you're going to hand over to your colleague now?
Yes, I'll hand over to Martin now, who has another set of slides for you to have a look at, and then I think we're doing a bit of a double act here on this one.
Okay, thanks, Barry.
Yeah. No rest for your voice, Barry. Apologies. Right, I shall share my slides. There you go. So hopefully you guys can see that. Let me know when the slides come up, Barry.
Yes, we can.
Fantastic. Brilliant.
So we can even see the sneak preview of the next slide at the same time. That's good.
Oh right, okay. So 2 seconds.
I don't know how you fix that though.
That's easy. I just shared the wrong screen. Apologies, guys. Apologies. 2 seconds. Now some of this might be broadly familiar to you guys from previous slides that we have done. Picks up off the back of the valuation, but also links in, gives you a bit of an update on what we've experienced with some of the ill health insurance that's been in place since I think since the last one. So let's have a go at this. Hold on a second. Technology. Right. I'll do this when it's not working as well as I was thinking with the screens today. So we'll crack on with this one. So yeah, what we're going to do today is go through, first of all, a little bit about what the ill health early retirements are, where the cost arises. So Barry has given quite the high levels, went in a little bit of the detail of the nitty gritty of how employer results can vary. So we'll go a little bit into ill health retirements, how that creates a cost to you as an employer, and also how then that cost, kind of on a theoretical basis, how that then has come to fruition for specific employers in Hertfordshire. Then the insurance aspects as well, how that might help mitigate that should somebody choose to do so. And then we're going to run through some funding considerations, which that is the link to your contribution rate and the offset that you get with the contribution rate, or whether or not that applies. And Barry will go into that a little bit. Again, that's where Barry will jump back in a little bit more on the detail on that one. So first of all, just to really not go into too much detail on this, but this is the key part where the costs kind of come from, is understanding what happens to members when they get ill health early retired. So if you imagine you've got an active employee, and that active employee is no longer able to work due to ill health, the LGPS has quite generous benefits for that, and the benefits depend upon the level of illness of the member, and the essentially 3 tiers. And as you can see on screen, we've got the tier 1 is the top tier. Now this one is where the member is not likely to return to work until like before state pension age. So again, quite severe conditions on that. The benefit that the member then is entitled to is that member gets their accrued service. So anything they've been in the scheme, that gets paid immediately. And they'll also get an enhancement of service. And that enhancement will be 100% of what their service would have been had they stayed in the scheme until state pension age. And again, that's because of that severity level. So younger member, that's quite a lot of extra service that they would get if they were deemed to qualify for a tier 1. The next level down, not quite as severe in terms of the level of ill health on it. The member is not expected to return to work for at least 3 years, but will be at some point before state pension age. Similar types of benefit that we get for that one is that we get the immediate payment of their accrued pension, but they also get an enhancement. Because there's a little bit more uncertainty in that, the enhancement is only 25% of extra service. So not quite as big a pension that's been awarded, but still extra pension being awarded. And then we've got the tier 3, and that is almost like a temporary payment where the person might be expected to return to work within those 3 years. So they'll get their pension that they've accrued just now. That'll be payable for a period over that 3 years. And then in the middle, it may or may not get upgraded to a tier 2. And again, at the end, it may or may not get upgraded to a tier 2. So they might get an enhanced level of service, tends to be not as high a level of ill health. So again, the key driving force here is the regulations, and what the member gets, the benefit they get, really is determined by their medical condition, a review from the IRMP. So that's the basics of the regulation. So how does that kind of come out? If we look at an example of a member, so if you imagine you've got an academy, you've got £1 million payroll, you've got an employee who's 45 years old, 10 years of service, so they've been in the scheme for since 35. They're on a 25k salary, so not on the higher earning element of that. The pension that they could be entitled to if they were going in tier 1 could be that would be about 16,000 per annum. So if you imagine that's 20 extra years of service that they're given from 45 to over 65. And they're also getting that early payment of that 10 years of pension that's getting paid now from 35 to 45 rather than being paid in the future. So that's getting paid early. That always kind of results in a cost. Now we'll go through very kind of quickly a little bit about why that cost arises. So first of all, if you imagine just under normal retirement, what you might get. So this member might have been paying in contributions from 35 and they would keep paying in. Imagine they stayed in that scheme all the way through to retirement. Those contributions are going in to fund the pension. They go at 68, they get a lump sum. They then get a pension paid. And then if there's a dependent, that would then get paid upon the member's death as well. So that's the kind of the benefit structure. The key thing here is really just that the member has paid contributions over that longer period. And if you can see the period of the pension being payable is from 68 as opposed to being paid any earlier. And then if we flick to the next slide, that's where it kind of shows this is how the cost arises here. So for this, the member has paid in less contributions if they go on ill health at 45. They've only paid in over that short period of time. The pension is potentially payable for a much longer period of time, and could also be a higher pension because of pension increases and such like. But the key thing is they've not paid in as many contributions. It's been paid earlier and it's been paid for a longer period of time in terms of the amount. So those things all add up to a cost which is not borne by the individual member. That cost then gets borne by the employer. And if you recall on Barry's slides, where we're talking about liabilities and assets, what we term the strain cost is the strain on the fund, so the extra cost on the fund for paying these benefits. So the expected cost of the benefits was that first slide, where that the member might be expected to stay in. But actually, what they're paying is higher. It's paid a bit earlier, it's paid a bit longer, and that creates a cost to the fund. Now, in this particular example that we were looking at, £16,000 was what we were saying was the pension amount that the person would get. The strain cost, so that cost to the fund, that was £320,000 for that in that example, and that doesn't get met by the member. That needs to then get met by the employer. So the employer would need to meet that cost. Now, because that cost arises, that's kind of where how do you kind of protect yourself against that cost? And well, we've spoken here about theoretical example, what's actually happening in practice and what has happened in practice for Hertfordshire. If we look at a few different cases, we'll quickly go through these on the screen. The top 3 cases that we have are cases prior to the insurance. So usually the insurer will look over a 5-year period. So you'll see some of the larger cases. The latter 3 are actual claims for insured employers that we've seen as well. And for me, the striking thing about this is all of these examples, that the members are not actually that young on there. And also the salaries are not over They're not £100,000 salaries or such like, but they can result in still quite high strain costs. Now we've kept the salary out for the insured employer ones at the moment because that doesn't feed through in the claims, and that information doesn't come through on it. But if you can see, certainly recently in the insured employers, we've got one that was 50,000, which in comparison terms is not as much, but 180,000, and then there's one at the moment which is going through, which is 470k, which is obviously quite a large amount. Within the fund, you might see, and it's typical across the LGPS, average strain costs within the fund, it's about 80k, and we're looking about 30 across the fund, and a lot of those might be at the council, but there will be more at academies as well. We've seen individual strain costs again 714k. That, I don't think that was specifically an academy, but at trusts and such, like if it's higher earning people, that's possible within it as well. Within that, you might have smaller amounts, but again, it's the potentially catastrophic ones or really significant ones that this is covering. And as you can see, that particular one at the bottom is I feel as it's quite a good example. There is also, if you notice the in progress, but we'll come back to that just at the a little bit later, just to explain some particular point about the insurance, because it's a question that we often get asked, and this case is relevant to that without going into the individual details of it. So that's a cost, and then if you have that cost, the cost arises, the fund may look to invoice you for that. How can you protect yourself from that? Well, there is ill health liability insurance. It is an option for employers. Again, it's not mandatory. Employers don't have to take it. You wouldn't need to take it out. It's there if you want it. If you don't, that's also fine as well. Just a little bit about how it works. The insurance itself is provided by Legal & General. Their group protection side, which is linked to, if you imagine if you're a private sector company, you physically were getting an ill health early retirement, the insurer would pay that pension out. So that kind of part of their business, so they've got a lot of expertise in that. It's available to all employers in Hertfordshire, so it's not just academies, and it's available to, it covers the tier 1 and the tier 2 ill health retirement. So the other ones that we spoke about where we had the enhancement costs, because they're typically the larger ones. The other ones, when the tier 3 is it's a temporary payment. If it got upgraded to tier 2, that would be covered. Within the insurance, you also have an employee assistance program, and L&G have this thing called Care Concierge, which is for care members family members may be looking for care. That service available to all employees. So the insurance is specific to LGPS members and tier 1, tier 2 ill health retirements. The employee assistance program can be accessed by all of your employees, regardless of whether they're in the LGPS or not, and similarly with the Care Concierge. So it's a little bit of a quirk of the additional service, but it's just included there. And the premium rate may be offset against employer contribution rate. Now that's depends upon the circumstances you have. Where I think that's probably whether or not you're in the pool for the academies. The current rate is 1.65% of pay, and that's until 31st of March next year. Now there is a review that's ongoing at the moment, and the insurer is looking at that to see, okay, is that the same rate that would then apply for the next year and probably for the next kind of like 3 years, or certainly at least the next 2. They'll look at that and consider is 1.65 still the appropriate rate. There may be a change in that might go slightly up, it might go slightly down. It may stay the same, but that will be communicated hopefully. Again, that may be around kind of January. So if there is, when that's coming out, if employers have insurance, you can consider and say, well, actually, at that rate, is that still valid? But we don't expect very much, if anything, to change on it. Where do we come into that in terms of Hyman Robertson? Well, we provide the administration services on it for the insurer, so between the employers and the insurer, and also if need be with the fund. But the main kind of benefit of, in terms of from your side of having us involved, is that translation piece as the LGPS experts, knowing how the fund works, how the health retirement process works, how the employers work, and being able to ensure that everything runs nice and smoothly between you and the insurer. Actually, how the insurance works is fairly straightforward. That rate of pay that you have, the member will get their pension, the strain cost arises, you would be paying a premium to the insurer, which is just your salary roll times that rate, nice and simple. If the claim arises, you submit that claim, it's paid back to you as employer, and then you can pay that into the fund, and that would then help to plug the gap. Now, in terms of something I meant to mention, it's on the bottom of the previous slide, so we'll just quickly jump back on it. Obviously, we do services, so there is a payment of that, and that's 10% of the annual premiums that we receive for that as well. So it's always just to kind of make that clear. Like I say, if somebody chooses not to do it, that's completely fine as well. What I'll do now is I'll just quickly jump on to the funding aspects, and Barry, this is the part where I'll bring you back in, where it's the link to contribution rate offsetting and such like.
Yep. I tell you, it might be better if I try. I've got a copy of the slides. I'm just thinking to make the slides bigger. It might be better if I take over and try and share. So if you stop sharing, I'll try and share my version. Yeah, I can hopefully get the full screen on. So have a look. You are now seeing a full screen version. Yep, perfect. So yes, from a funding perspective, how does this actually work? And whether you are insured or aren't insured, what's the impact on kind of your funding position, and indeed kind of any money that's payable to the fund or not. So as Martin pointed out, there's absolutely no obligation for you to take out insurance. It's very much your decision. We've shown in the next few slides kind of how it would work if you are in the Academies pool. So the Academies pool rate, so that's the rate I was talking about earlier, which is currently 22.65, and we're expecting to go down to 21.65% of pay. That doesn't have any allowance for ill health retirements in it. So we've already kind of stripped out the allowance for ill health retirements out of that. So you're basically in the situation of you can either insure and insure against that risk and pay the premium to the insurer, or if you don't insure and an ill health retirement happens and there's an additional liability, then the fund will basically kind of issue an invoice to you for that amount that is payable to the fund, because there is no, as I say, in that Academies pool rate, there isn't an allowance for any ill health retirements in that cost. So this first slide takes the example where you're in the pool and you choose not to take the insurance. That's absolutely fine. So there's basically, you pay your contributions, the 21.65%, into the fund, and that goes into your pot of assets. So that kind of green bar goes into your pot of money, if you like, that's to cover your benefits for your members. If you don't have any ill health early retirements, then there's no impact on the liabilities. There's no additional liability there. So you pay your money into the fund. The 21.65% goes into your assets, and there's no impact on the liabilities. If in the same situation you have no insurance and you actually had an ill health early retirement claim, then what happens is you're still paying the same 21.65% into the fund, but you have an increase in the liabilities because of this additional unexpected, if you like, ill health early retirement, which increases the benefits payable over and above what we were already allowing for. And so the fund would expect you to meet that cost as an employer, and so they would kind of issue an invoice for whatever that strain cost is. Now, the other example would be if you had the insurance. So basically you still pay the 21.65% to the fund, because that's still needed to cover the benefits, but you then pay whatever the premium rate is to the insurer, and that goes kind of a separate way, as shown in Martin's example earlier of where the money goes. So you pay the same amount to the fund as you would do otherwise, but you also pay a premium to the insurer. Now, in the situation where you've got that insurance and you don't have any ill health early retirements, then the situation on the right hand side is kind of unchanged from the previous example there, where you didn't have an early retirement. So you've still paid your money in, your 21.65 into the fund, into the assets of your own assets, and there's no impact on the liabilities. So if you don't have any ill health retirements, you're not having any impact there on the liabilities. If you have the insurance and you do have an ill health early retirement that occurs, then basically same situation from the perspective of you've been paying 21.65% into the fund, and that goes into your assets. You've been paying the premium to the insurer, whatever that may be. It's 1.65% just now, but as Martin said, that's being reviewed, so that might change slightly. So what would happen is the strain costs, in the same way as in the other example, there'd be an additional liability that pops in on your liability side from the fund's perspective, but you would expect to get a claim payment from the insurer that basically kind of helps to cover that amount. So instead of you being invoiced and having to pay that kind of out of your own pocket, if you like, you'd be invoiced, and then you would expect that the insurer claim would cover that. So it's basically as typical for any insurance. It's kind of paying out if you have that event happening, and obviously you won't get a payout if there is no early retirement actually occurring. And it's entirely up to yourselves in terms of whether you want to insure against that. It's basically the same as any insurance. Is there as a kind of mitigation in case you would rather kind of pay that premium to eliminate that additional potential cost. That was all I was going to say really on that. There was only one other thing, was those examples are all if you're in the Academies pool, because the Academies pool rate already has that kind of ill health allowance removed from the contribution rate that you're paying to the fund. If you were to opt to leave the pool, then what would happen is you would get your own contribution rate calculated, as I mentioned earlier, and if you were to then choose to insure against ill health, what would happen is you would tell the fund, and they can then make a deduction off your contribution rate you pay into the fund to allow for the fact that you're insuring. So it's basically to get you to back in the same situation from an insurance perspective as you would have been in the pool in terms of having that deduction applied. So if you're in the pool, there's no additional deduction because we've already removed it. But if you are out with the pool, you just let the fund know, and they can adjust the contribution rate that's payable if you have the insurance. Hopefully that's relatively clear, but happy to take any questions at this stage.
I've got one question, Barry, on the chat, and that's, how do you know if you're in the Academy pool?
Hopefully, if you're paying 22.65% to the fund at the moment, then that means you're in the pool. But yeah, as I mentioned, officers will get in touch with you shortly to basically ask you to confirm if you want to be in the pool or not. Generally, if you were in the fund at the last valuation, you should have received a results schedule then, which would have stated whether you were in the pool or not. But do just get in touch with officers if you have any doubts about whether you're in the pool or not.
Yeah. Any other questions? None in the chat. The main takeaway for the academies that are in the pool is that your contribution rate will reduce by 1%. You'll all be provided with your individual results as well that shows your own tracking position and funding level, and as Barry alluded to, they will be issued towards the end of probably mid-December onwards, but I suspect you'll get them in January. If there's no further questions, I'll end the session. Thanks, Barry and Martin, for your time and your presentation, and we'll see you all soon.